Welcome to Conversations at SC, held at the margins of the World Capital Market Symposium 2015. Today with me is Jacob Hook. Jacob is a partner in Oliver Wyman's Sydney office, and he works around public policy areas across Asia Pacific. Thank you for joining us, Jacob, today.
Thank you for having me, Lima.
Before we start our conversation, perhaps let me frame the context of our conversation today. Last couple of months, the SC registered 6 operators for equity crowdfunding. The next question, of course, looming is, should the SC now focus its attention on P2P lending? If so, what do you see are some of the benefits that we can reap from that for the capital market in Malaysia?
Thank you. The peer-to-peer lending space is a very exciting one globally. There's been a lot of innovation going on and a lot of very rapid growth of balances of debt outstanding around the world, particularly in the US. And I think this innovation really brings a lot of interesting potential benefits to countries like Malaysia. First and foremost, with the new and highly user-friendly and sophisticated origination and credit underwriting algorithms and platforms that these providers have, it's a much easier way for borrowers to borrow loans, to draw down funds, and to get access to credit. So there's a real consumer benefit that comes in there. I think also there's a filling of credit gaps that peer-to-peer lending can provide. So you see this in particular in markets like China, where there is an undersupply of credit to particular parts of the economy, particularly the SME sector, where banks aren't lending as much money as the companies would like to borrow. That means that peer-to-peer has been able in that space to fill a gap and to really help with the provision of credit across the economy. I think also diversification of sources of funding is a good benefit for the financial sector as a whole. So I do think it's a very interesting and high potential space for countries like Malaysia to be exploring.
Sure. I think there are also some views out there. I mean, given the fact that peer-to-peer lending has already taken off in a big way in the US, the UK and China, some say that it comes with a lot of risks. So what should lenders be looking out for? What are the red flags?
I think there are a number of interesting risks with peer-to-peer lending, and I think there are some analogies to the credit crisis in the United States in 2007 that I think everybody should be aware of. In the peer-to-peer area, we have originators of loans who are focused heavily on creating new credits to borrowers that are sometimes not of the most stable credit quality because of their limited access to the mainstream banking sector. And these originators are passing those loans on into the capital markets. And so I think that there have been some concerns in the US in particular that what we're seeing in this new growth of the peer-to-peer lending business is a repeat of that dynamic from some years ago before the financial crisis, where low yields are driving investors hungry for pickup of returns to invest in increasingly risky assets which are originated by entities that don't have skin in the game. So there's a set of concerns there that there could be some adverse selection in terms of the types of borrowers coming into peer-to-peer, and that there also could be perhaps not as much tight monitoring of credit quality of origination as investors might want to see. So those are some red flags to be aware of, but I think both of those can be managed with appropriate regulatory frameworks and investors that enter into the space well aware of the risks.
Yeah, I'm glad you talked about regulatory framework as I was moving to the next area of our discussion. You know, in the US, the SEC regulates peer-to-peer lending, and in UK, it's the FCA, and in Malaysia and in perhaps Asia Pacific, which regulator do you think is best suited for peer-to-peer lending regulation?
Well, it's a very interesting set of differences across countries that we see. So in the Asian context, China, for example, has peer-to-peer lending regulated by the banking regulator. And I think it really depends on the regulatory architecture in the country in question, because There are some parts of peer-to-peer lending which are relevant to central banks or banking regulators. So rules around credit standards, predatory lending, consumer protection, and so forth. In jurisdictions where that's the responsibility of the banking regulator, as it is here in Malaysia, I can see that there's clearly a role for that regulator in that part of the question. But in other jurisdictions, that protection of consumers doesn't always fall with the banking regulator. In Australia, where I come from, there is a framework that has all consumer protection sitting under the Australian Securities and Investment Commission. So in a situation like Malaysia's, where there's a role for the banking regulator on the consumer side, there's also, of course, a role for the securities regulator on the investor side, because the SC here is responsible for regulation of investment platforms and marketplaces and so forth, as well as entities that are distributing assets out to the investor base. So I think there's a need for cooperation across regulatory entities. If we think about what peer-to-peer lending is, it's closer to a marketplace than to a bank, but it does have some implications for financial stability, provision of credit and so forth that will be of interest to banking regulators.
Yeah. In one of the conferences, I think in Australia, you raised the concern about how regulation may stifle innovation. The most common approach is for regulators to look at how they can regulate the operator. Does that go against the very benefit of fintech, which is disintermediation? Are we bringing back the intermediary through the regulation of the platform?
It is a difficult balance for regulators to get right. I think in all of these types of decisions that regulators are making these days about new financial technology, they're essentially balancing, on the one hand, stability, the integrity of the system, protection of investors and so forth, against the potential of innovation. And so in this instance, the question around regulation of peer-to-peer lenders, I think there is a role for oversight of platforms to make sure that they are being transparent about the information that they have and are able to communicate clearly the quality of the loans that are being originated. I think, though, I would generally not be so supportive of requirements for such platforms to have liquidity and have balance sheet strength in the same way we might expect a bank to.
Right.
I think there's a difference there in terms of the type of entity it is. And also I think there's role for regulators to focus on protections on the investor side. So limitations on how much might be put into these platforms, for example, can be one way to get more comfort around the aggregate amount of trouble a problem in the future in the peer-to-peer space could cause.
I see. Interesting. Can I now move on perhaps to another new phenomena in the fintech space, which is the robo-advisors? I mean, it's been an increasing, we see mushrooming of fintech companies offering this type of services. How do you see the regulation of robo-advisors panning out?
Robo-advisors shouldn't be considered too different from normal advisors. So there's questions in the regulation of financial advice around ethics, around incentives, around fair treatment, and all of the rest of the package of consumer protection requirements that many regulators have for financial advice. And I think all of that, in general principles, ought to still apply in the case of robo-advice. So clearly robots can't have ethics, but we can ask whether the algorithms are embedding incentives or decisions or biases which are ethical or unethical. We can ask, are there conflicts of interest in the business model which might be playing out in the types of advice that these algorithms are giving? So that's one question that regulators have to grapple with. I think there are also issues that they need to face around, do they have the capabilities and the right processes to oversee robo-advice models? So traditional compliance frameworks around financial advice are quite linear, quite paper-based, quite focused on whether the right steps have been taken. But in an interaction with a robo-advisor on a website, which may or may not also have involvement of a human advisor somewhere in the process, the customer's journey becomes quite non-linear and quite complicated. And so there's often a need, I think, for regulators to think about how their frameworks need to evolve in order to capture these complexities, to make sure they can cover them well.
is it possible at all for regulators to replicate fit and properness criteria in this space? Seems almost impossible to me.
Well, I think fit and proper criteria can still apply to the officers of the company that designs and develops the robo-advisors. There's an interesting question that I suspect many regulators will be grappling with for the next few years to come, which is, to what extent should we concern ourselves with the algorithms themselves? Should regulators be auditing algorithms to see if they are accurate and to see if there are any biases or tendencies inside them that they would be uncomfortable with? Or should they say, well, that's a black box and we're happy to keep it that way, and we will do what we do with human advisors, which is audit from time to time the results, the outputs, the actual advice that they give.
Right.
I think in some ways auditing algorithms is a big step for regulators. It would require lots of new skill sets, but it could be quite powerful in terms of very efficiently being able to understand the types of advice giving across an entire network, rather than doing spot checks, for example, of a single advisor's financial advice in the human advice world.
Right. So this takes us now nicely into this space of RegTech. I mean, it's this notion of how regulators will apply regulation technology. And some people are of the view that the financial industry is, the first industry which is so highly regulated that's entering this space in the disruptive era. So how should regulator embrace RegTech?
I think RegTech, by which we mean the application of new technologies, digital technologies, to regulatory questions, can be very powerful in the same way that it's very powerful to use big data analytics or tools and techniques to solve business problems in the corporate world, and we obviously see a lot of investment going on around that. So regulators could increasingly be using algorithms, big data analysis to pull together pieces of information that they have inside the enterprise across all of their different activities, as well as bringing in pieces of information out in the public markets and using that to generate insights and intelligence to guide their regulatory activities. Right. There's a lot of potential there, but there's a lot of investment that will be required by regulators to really get ahead of this challenge. Certainly, we've been seeing banks and other large financial institutions spend very large amounts of money for long periods of time to develop these capabilities. And I think many regulators, while well aware of the possibilities, are in quite resource-constrained situations and are just at the beginning of that journey. So I think we'll see them being selective about areas that they can pick to use technology to improve regulatory outcomes.
Sure. Now, there have been some suggestions that perhaps regulators should move from their conventional way of regulation or introducing regulation. They should now use the approach of clinical trials, like what the labs would do before they introduce a new medicine. So do you think that's possible for the financial industry?
So I think it's a very important idea. I think of it broadly as part of the challenge that I alluded to earlier that regulators have, balancing innovation and safety and soundness. And broadly looking at what we might call graduated frameworks of regulation, where essentially we apply increasingly intense regulatory scrutiny and increasingly significant burdens on enterprises as they become more significant to the economy and as their ability to cause disruption or to inflict harm on investors or consumers if things go wrong increases. However, at the lower end of that spectrum, where we have many small enterprises, innovative startups and so forth entering into the market, that type of burden can be quite unsustainable, and we can end up essentially making it impossible for certain innovations to flourish if we have that type of approach. So therefore I think having an approach that allows the waiver or reduction of regulatory burden for certain innovative applications is an interesting way to see if you can explore what the innovation is, if there's a customer benefit, and what, if any, structural or regulatory changes might be required in order to make it work. In terms of clinical trials, it's an interesting concept, because obviously we can't test things in financial services in the same way that we can in pharmaceuticals. And across the world, the FCA in the UK is really leading the charge in terms of
Right.
thinking about this, and has put a lot of effort into developing it as part of their project Innovate. And it's early days yet, I would say. This is all just coming together this year, so it's difficult to point to a lot of examples of it being successful. And it may be that, in fact, it's less the experiments and the clinical trials, but more the clear evidence that the regulator's willing to engage with innovators and help steer them around the issues and pitfalls in the regime, and also help respond to their concerns that might be most important in terms of bringing forward new innovations.
Yeah. Given that these trials or experiments may take some time, do you see it more appropriate for a situation where you want to change existing regulation, or is it also useful when you want to introduce new regulation? Seems counterintuitive for, growth in technology which is so fast-paced, and yet you're having your lab, trying to test whether certain set of regulation works.
Yes, I think you can end up with a bit of a delay in development, and regulators obviously would need to invest quite a lot in each instance where they're making special changes to the rules, and that becomes a little bit like picking winners, which is a bit difficult to do for anybody, and it's certainly not the objective of regulators, which is why, going back to my earlier comment, I have sympathy for graduated frameworks that actually don't require specific waivers when you're talking about very small enterprises that can't necessarily cause a lot of damage to the system or to consumers. So having a framework that doesn't require case-by-case waivers or no action letters, but rather for below some threshold, allows a greater degree of freedom, could be a more efficient way to achieve the same aims.
Before we end this conversation, just one last question I have for you, Jacob, is that if today you're given the authority to, set up a 21st century regulator, what would be your 3 priorities?
That's a very broad question, and I think some parts of it relate to what we've been talking about today in terms of technology and innovation. I would certainly say that one of the priorities ought to be a strong handle on what's going on in the innovative financial technology space, and deep engagement with that space to ensure that the rules and settings are correct, but also, as we discussed earlier, a regulator that can really leverage those capabilities and use those in its own day-to-day work. I'd say, secondly, it would be very important to have a regulator that focuses on culture of the financial industry, and has the ability to take a preventative and a judgmental type of approach to assessing questions of financial intermediary conduct and culture and so forth. Finally, I'd say a regulator which has got a broad toolkit in terms of the ways in which it seeks to influence the industry, and has a clear understanding and clear framework around which tools, be they soft tools, communication and engagement, or be they some of the more formal legal tools of enforcement it uses to achieve its outcomes.
Thank you, Jacob, for joining us at Conversations at SC.
Thank you for having me.